Now, what I intend to cover with you today is to take you through some of the highlights of the impact assessment work that we've been carrying out. And I'll do that in a couple of parts. I'll begin with an introduction and some preliminary findings. It's important to take you through the approach that we have put in place, but also some of the caveats and limitations of that approach. We'll focus on both the revenue effects, but also the investment effects, and then give you a sense of what some of the next steps in the process might be. Now, to begin with some high-level preliminary results, but also with a focus on the overall approach, it's important to recognise that the impact assessment work has very much been undertaken with the purpose of informing members of the inclusive framework, all 137 of them, as they work towards taking some of the key decisions, both in terms of design, but also the parameters of both Pillar 1 and Pillar 2. And a key element of that has been that we have developed and been sharing with countries on a bilateral basis revenue estimation tools that have allowed them to model the impacts of various types of design and parameter choices on their jurisdiction. Now, those are not available publicly. They are provided on a bilateral basis. We work closely with the countries to make sure they have that information at their disposal. But obviously, as we move towards a publication of a final analysis, as it were, we would like to include results at the greatest possible level of detail when we get to that point. Now, of course, any impact assessment of the sort that we have been carrying out does require a series of assumptions to be made. I will try and be clear about what assumptions have been taken. Some of these are reflected in notes beneath some of the graphs. And I would ask you to, if it's not clear, the assumptions that we've relied upon, to consult the slides, and you will see exactly what parameter choices in particular and design choices we have put in place for each of those assessments. Now, the results are by nature, what I'm sharing with you today are by nature high level. They are presented at the jurisdiction group level. So that means that we will present results that largely relate to low, middle, high income country groupings, as well as investment hubs. And of course, these results and the work that we're carrying out will be updated as future decisions are taken by the steering group of the inclusive framework and indeed the inclusive framework itself. Now, just a snapshot of some of the high level preliminary results. We see that the impact on global tax revenues of the combined implementation of Pillar 1 and Pillar 2, based on the assumptions that we have calculated, would produce a significant increase in global tax revenues. So we see a substantial gain in revenue. Obviously, that depends on ultimate design, but certainly in terms of the parameter choices that we've modelled and the assumptions that we've taken, that is the case. The revenue gains are broadly similar across high, middle and low income economies, and that's measured as a share of corporate tax revenues. The reforms are expected to lead to a significant reduction in profit shifting, and you'll see that in large part this is as a result of both Pillar 1 and Pillar 2 reducing tax rate differentials and therefore reducing some of the incentives that exist for firms to engage in aggressive tax planning and profit shifting activity. And of course, failure to reach a consensus, the counterfactual, if you like, failure to reach a consensus-based solution would lead to further unilateral measures. That would lead to, obviously, more double taxation, greater tax uncertainty, and we've also seen in some very high-profile cases recently that this can spill over into trade retaliation and the potential for trade wars to emerge as a result of a failure to reach agreement. Now, in assessing the impact of the reform, we have put in place a flexible analysis framework, and that has really been what has allowed us to share with countries a tool that gives them the ability to play with different design and parameter choices to see what the implications of different reform scenarios might be for their jurisdiction. We have broad geographic coverage and company coverage. So we cover more than 200 jurisdictions, including all of the Inclusive Framework members and many others. And we have country or company coverage that includes more than 27,000 M&E groups. Now, we combine data from a range of data sources, and that, I think, is one of the best elements of the analysis that we've been able to carry out has been no single source of data is going to provide you with sufficient quality of information to assess these impacts. We've had access to all of the best available data, but we have drawn upon them and combined them into an aggregate data set. And all of this has occurred with extensive interactions with stakeholders. And Martin mentioned earlier the engagement we've had with other international organisations. We've worked very closely with the IMF in particular, with other international organisations, the EU we've worked very closely with, and indeed we have held a number of academic workshops where we have tested our approach and our methodology with a number of people, and some of whom I note are participating in this event today. Now, in terms of the main caveats, and there are always plenty of caveats that one might wish to share for an impact assessment of the sort that we've carried out, the results do depend upon the ultimate design of the various pillars, and that is something that continues to be the subject of discussion amongst Martin and his colleagues at the Inclusive Framework. And there will be further revisions will be needed to this impact assessment as those decisions are taken. Importantly, some of the discussion that you may be aware of around the US proposal for a safe harbour regime. What I present today does not take into account estimates modelled around a safe harbour regime. So that's an important caveat. In terms of the underlying data and the limitations that they have, clearly, as I said before, no data source is perfect. We pulled together a range of them, but of course, due to gaps in coverage and in some cases time lag issues, a lot of the data that we are relying upon in order to have a consistent data set across the various sources is a 2016 data set. Now, obviously, a lot of things have happened since then, but we cannot use data that we do not yet have access to, and that's an inherent limitation. I should just mention some BEPS implementation has still been carried out since 2016. The US tax reform occurred after that. And of course, none of this is able to take into account, at least in the statistics that we use, the data that we use, the impact of the current pandemic and its implications. And of course, we make a number of simplifying assumptions in order to allow us to model what would otherwise not be possible. And refinements continue, in particular, in cooperation with member countries. Now, in terms of potential strategic reactions, and this is an important point, both of multinationals but also of governments, for Pillar 2, we take some of these reactions into account and seek to model them in the assessment, but there are other reactions that are much more difficult to anticipate with certainty. So we've tried to do that, but we recognise that it is not complete because we cannot anticipate some of the potential behavioural reactions. Now, what does this mean in terms of revenue? Well, this slide here is showing you the impact of Pillar 1. This is assuming that we have a profitability threshold of 10% profit before tax to turnover, and a 20% allocation of that amount is then allocated to market jurisdictions. And what we see here is that the global effect, depending on whether it's 10% or we also have in red a 20% profitability threshold. So the blue is the 10% threshold, the 20% threshold for profitability is the red. We see overall the global effect is reasonably modest, even more modest if you set the profitability threshold at 20%. But we see that there are gains to be expected for high income, middle income and low income countries on average. And of course, investment hubs defined as being those jurisdictions with inward FDI above 150% of their GDP. They are those that do not gain in revenue as a result of the introduction of Pillar 1. Now, the scope of residual profits at this point did not take into account the more narrow focus of automated digital services and consumer-facing businesses. That work is ongoing. We've been sharing some more recent results with member jurisdictions to that effect, and that work continues to occur. But you can see there the impact of Pillar 1, modest but significant. They will certainly have a positive impact for most jurisdictions except investment hubs. This slide summarises some of those points, other than to also note that more than half of the profit allocated under the scenario that we just presented slides on relates to profit that is coming from about 100 M&E groups. Now, in terms of Pillar 2, I mentioned before the need to go beyond a static scenario analysis. What we do is we start with scenario 1, which is a static reaction, no reaction scenario. We then look at scenario 2, which would take into account the interaction between Pillar 1 and Pillar 2, assuming that Pillar 1 would take effect before Pillar 2. We then consider scenario 3, which takes into account the expected reactions of multinationals and reduced profit shifting as a result of the implementation of both Pillar 1 and Pillar 2. And scenario 4, we take into account to some extent some low tax jurisdictions increasing their CIT rate as a result of the introduction of Pillar 2. Now, of course, there are a whole range of additional behavioural responses. In particular, there may well be multinationals making different investment decisions and relocating real economic investment. We do not seek to model that in the analysis so far, and to some extent that is in large part because of many of the uncertainties around exactly what their behavioural reactions in that regard might be. Now, if we have a look at the impact of the combined effects, I'll just go back, the combined effects of Pillar 1 and Pillar 2 across those 4 scenarios, you see scenario 1, that's the static one. Scenario 2 is the one that takes into account the interaction between Pillar 1 and Pillar 2. The blue being the revenue collected under Pillar 1, the green being the additional revenue collected under Pillar 2. Then we have scenario 3, and the red or the brown colour there represents the additional tax revenues that will be collected by jurisdictions as a result of reduced profit shifting activity. That is in large part determined by our analysis of the broader literature on responses to tax rates by multinationals and the expectation that profit shifting will reduce as a result of reductions in those tax rate differentials. Scenario 4, the hatched yellow part of that of the column there, that relates to some of the additional revenues that will be collected by low tax jurisdictions as a result of increasing their tax rate in response to the implementation of Pillar 2. Now, we see that Pillar 2 would potentially raise a significant amount of additional tax revenues. If you look back on that graph there, the combined effect of Pillar 1 and Pillar 2 approaching 4% of global CIT revenues, which puts it in the ballpark of around $100 billion US. Now, obviously, that amount ultimately will depend upon final decisions on design, on rates, on key parameters, and they remain ongoing issues. The principal scenario we've modelled has been a jurisdictional blending scenario with a 12.5% minimum tax. Now, the reform would, we anticipate, reduce profit shifting. Pillar 2 would reduce tax rate differentials between jurisdictions and reduce the incentives for multinationals to engage in profit shifting. This will be particularly important for developing economies who tend to be more adversely affected by profit shifting than high-income economies. Now, to some extent, that's because of their heavier than average reliance upon the corporate income tax. Now, we see here some illustrative scenarios of what the combined effect of Pillar 1 and Pillar 2 might have across high, middle and low income countries. And you can see there that obviously Pillar 1 is playing a more significant role for low income countries, and then middle income and then high income. Pillar 2, which has assumed that the income inclusion rule would be applied before the undertax payments rule in a sequencing scenario, but that continues to be the subject of discussion among members of the inclusive framework. But on that scenario, we see that Pillar 2 is a significant contributor to high income countries, and reduced profit shifting incentives and the dividend, if you like, that delivers to all jurisdictions is also of some significance. Now, in terms of the investment effects, and I know that we're pushed for time, so I'll move through this very quickly, but we have essentially undertaken a series of empirical pieces, one where we use effective tax rates, forward-looking effective tax rates, to assess the impact on investment costs of these increases in the levels of tax that MNEs will be subject to. We have also considered the impact of ETRs on investment and the fact that it may vary across firms. And we've looked at the sensitivity to movements in tax rates of different types of firms. And in particular, we have noted that often firms with higher levels of profitability are those that are the least responsive to movements in tax rates. And there can be a whole range of reasons to support that conclusion. And we will, of course, be considering not just the impact of what these reforms will mean, but also the impact of a failure to reach consensus and a failure to introduce any new measures. And that counterfactual scenario, as I referred to earlier, will be one where there will be an increasing proliferation of unilateral measures. We see that many countries have already threatened that, some have already introduced them. And we've also seen some very strong responses from countries opposed to the implementation of those unilateral measures, and that has led to considerable threats of trade retaliation and the prospect of potentially a trade war if an agreement were not reached. Now, we see in this here an illustrative scenario of the combined effect of Pillar 1 and Pillar 2 on effective tax rates, forward-looking effective tax rates. We see fairly modest impacts for most countries, high income, low to middle income countries. Obviously, the picture would be slightly different for investment hubs, who will see some larger increases in investment costs. But overall, we see fairly modest increases in effective tax rates as a result of the implementation of these reforms. Now, as I said, the direct effect on investment costs expected to be small. Many firms, of course, would be unaffected by the proposal. So if you're not generating at the group level high levels of profit, then you will not be affected by Pillar 1. And if you are not engaging in some degree of profit shifting activity or achieving low rates of effective taxation, you will not be affected by Pillar 2. So not all firms will be affected. And the reforms would likely reduce the influence of corporate taxes on the investment location decisions that firms make. Of course, a whole range of considerations that firms take into account, of which tax is one. But if you reduce the differentials in tax rates, that will reduce the significance of tax as one of the more significant of those considerations. And of course, as we said, failure to reach consensus has its own significant implications. Now, in terms of what this means for next steps, very quickly, the grey areas, we've already been there. Martin's covered some of this. The virtual meeting of the inclusive framework in July, that's the one that was to be a ministerial meeting, but will no longer be. We have the October inclusive framework meeting, where we hope to reach agreement on key policy features. And there will also be the G20 finance ministers meeting in October, with the leaders meeting in November. So we are moving ahead at full speed. Obviously, the pandemic has had a big impact on everyone's ability to move forward with their normal work programs, but good progress is being made. We are still trying to deliver, as the G20 has mandated, a consensus-based solution by the end of the year. Of course, there will be some elements of that that may need ongoing discussion moving into the new year, but we continue to work hard towards delivering on that time frame. I'll leave it there. There are a number of other slides in the annexes, but I'll leave them for those of you that wish to peruse them at your leisure.